So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and I'm joined today by Jorge Newbery. Jorge is CEO of preREO, the nation's leading online marketplace focused exclusively on the sale of distressed mortgages from institutions to real estate investors. preREO is powered through crowdfunding from non-accredited and accredited investors who can invest for as little as $100. Jorge is CEO of American Homeowner Preservation, Inc. and leads 9 for-profit social impact companies. Jorge, welcome to the show.
Thank you so much for having me, Jonathan.
Absolutely. Very excited for today's conversation. We've connected very well off camera. So let's kind of jump into it here. Obviously you're very busy. You got a lot going on, but kind of take us back to the very beginning and tell us, where you're at and what got you to where you are now.
Sure. So I've been an entrepreneur all my life. I mean, almost all my life. I had my first job delivering newspapers at 7. I started selling ice cream from a kind of a push cart when I was probably around 11, and things have gone from there. I had a record company in my parents' garage starting when I was 15, and then I started racing bikes. I was in the 1988 Olympic trials, and I raced bikes for a living. A modest living for about 6 years. By the time I was 25, I needed a real job. My first job was working in a contact center for a mortgage company, and that was in 1990, so a long time ago, about 32 years ago. And that kind of got me into this business. I kind of took all that focus, that energy, that determination that I had as a bike racer, took it into my job in the contact center. And, within 6 months, I was a top producer there, even though I came from no mortgage background, and things just grew from there. I started, within a couple of years, I started my own mortgage company, and then I started buying properties. And this was in the early 90s in California. It was a downturn. I was able to buy smaller multifamily properties and progress to bigger multifamily properties. I started with 4 units, and within about 3 years, I bought a 298 unit building in downtown Los Angeles. So I grew from there. And by 2001, 2002, I had about 4,000 apartments across the country. But the unhappy ending is that an ice storm hit my largest holding, which was 1,100 units in Columbus, Ohio, triggered an extraordinary sequence of events in which I lost everything and ended up $26 million in debt. So that whole decade I was like, I'm a reformed workaholic, but during that period, I worked hours and hours and hours, and to exit after all that time, 15 years later, to have given it all back and then some. It was a challenging experience. You go through feelings with a loss like that of shame, failure, embarrassment, guilt. Where did I go wrong? What could I have done differently? Why did this happen to me? The only upside that I could see at that point was that by 2007, when I started hearing about families across the country experiencing those same feelings, with the what turned into the housing crisis, I started AHP, and the goal was to help families at risk of foreclosure who are facing the same challenges that I had, maybe on a smaller scale, but the reality is we all ended up broke. So it wasn't indifferent in that regard. So that I use that experience, and that's what's helped me rebuild for the last 14 years.
Wow, that's incredible, and so awesome that you picked yourself up and rebuilt from that, because that's a heavy burden, for sure, for anyone, of course. So was it over leverage? Is that ultimately what kind of led to it, or?
Bad decision. I mean, I take responsibility for what happened. This property we had the largest natural disaster in Ohio history was this ice storm in 2004, Christmas Eve. And it just devastated this property. We were well insured. We had $50 million of insurance. In the end, the damage was over 45 million, which is, it's hard to fathom how much money it would have taken to rebuild that property. We were, and what I didn't know at the time is that if you have a massive insurance claim, then the insurance companies typically will simply deny you and make you sue, which is what we had to do. So the insurance company said, no, this isn't covered because of, they said we didn't have boiler endorsements. We didn't have boiler endorsements, and the exploding boilers is what caused the damage. And it just wasn't the case. What had happened is this ice storm came through, knocked out power to more than half of the city. Our buildings were without power for 4 days. During this period of time, the temperatures outside were negative, like -8. And so all the pipes, so we had 122 buildings on 54 acres, 1,100 units. All the pipes that we had these boiler heating systems, so this hot water which would circulate through the units and radiate the heat. All those power goes out, boilers stop working, all that water stops providing heat, but then starts freezing. So it started freezing, and once that froze, all the domestic water froze, and we also had no power. So we had thousands of people living there. We had no power, no water, no heat, sub-zero temperatures, and just a true natural disaster. The Red Cross opened a shelter across the street. It took 4 days to get power back onto our building. Other buildings got it back earlier, but our buildings took 4 days, and they had emergency crews out there all the time. But it was just truly a disaster. Now, insurance company denies. My attorney says, hey, we'll sue them. Eventually, they're going to pay you. So I made a huge mistake. I said, okay, what I'm going to do is, I have all these other properties across the country that are in cash flowing. They're in good shape. I'm going to take out loans on those properties and use that money to help rebuild Woodland Meadows. And then once this insurance company pays off, I'll pay off those loans. That seemed like a really simple plan. But I was thinking at that point it's going to cost like $5 million to rebuild, and it was just, the damage was extraordinary, and it was just a lot more than that. So my $5 million exhausted. I borrowed more. I got to about 18 million. I ran out of money, and the buildings were half done, and so all the contractors walked off, and the insurance company still hadn't paid. So and now the worst part of it is that the city. Somehow the city decided that they wanted the property. We had the biggest single piece of land in the city of Columbus, and that they wanted the property, and they didn't want low-income housing in the area that we were, because it was backed into Bexley, which is one of the highest income areas in Columbus, and here you have this huge low-income housing project. So they sent inspectors out, and those inspectors, it's like, this is out of a movie, but they said, hey, these 122 buildings, we just did these inspections because on the first floor, we had to rip out all the drywall because it was underwater due to the storm. And so now it exposed construction defects by a prior owner, and that all these construction defects rendered the buildings subject to imminent collapse. And so they issued 3-day evacuation notices that all these buildings had to be evacuated within 3 days. And so I went to, I hired an engineer. The engineer came out and said these buildings are not subject to imminent collapse. My attorney filed a temporary restraining order against the city for evacuating the property. So we all went into court, and in court, I had my engineer's report, and the city was there. They had no report. Nothing that backed up their findings, that just like, we think these are subject to imminent collapse. And I have an engineer saying they're not subject to imminent collapse. And so we got the temporary restraining order against the city. But that probably wasn't a great move either, because now the city went to HUD and said, hey, terminate all the contracts there. And HUD came out there and was there literally like minutes and said, hey, your buildings, all the work isn't completed, and you have 30 days to complete the work. Now, as part of the court hearing, the court had appointed a construction monitor, and we had come up with a plan that we're going to get all these buildings done within 6 months. And we called, and I told my attorney, call the insurance company, get the best deal you can get, and let's get this done. So the insurance company cut us a check for $32 million, which is a lot of money, but it wasn't the 45 that we needed, but I took it. And we went up to 200 people working a day at the property. Every Monday we had a construction meeting. The court-appointed monitor was there, would file reports every week saying we're making great progress, we're well ahead of schedule. And so HUD said you had 30 days. So we went to court and said, hey, we're all on your schedule, but HUD's saying we have 30 days. So the judge summoned HUD into court, and HUD replied and said, hey, we're a federal agency. We're not subject to a municipal court. We're not showing up. And and so we kept working. I was saying, okay, well, we're going to make this work. And after 30 days, HUD came out. They were there again, minutes, and they said, hey, you're not done. They sent us a notice saying all your contracts are terminated. And because we had a project-based Section 8, which had paid for about 440 of the units. We had vouchers in about 150 units. And so now all that was being cut off. So that was basically the end. Now I was left 6 months later, the property was closed. HUD and the city relocated all the residents. They gave them free vouchers. So as soon as everyone was told they get free vouchers to move wherever they wanted, I lost all support amongst the tenants. And 6 months later, the property completely vacant, and that was the beginning of the end. I mean, that was actually the end was coming. Now I lost a good chunk of my properties to foreclosure. I at that point I had levered them, but to support this one property, it just was a disaster. And so that was how it ended. It got so, and to add kind of to top it off, during that period, as I continued to try to fight, the city, the mayor, they wanted this property. They own it today. They got what they wanted. But they would, they somehow told the media that I was under criminal investigation. And my attorney called and said, well, what's he under investigation for? And they said, we called the city attorney. He says nothing, but the mayor, they never took it back. And now this was in the paper. And then I was actually arrested for failure to appear at a city council hearing. It just, the whole thing turned into a political theater. I was the mayor, Mayor Michael Coleman. He did an interview with one of the newspapers and called me public enemy number one. It was like, I was just like, oh my, I just got pummeled. And some of these articles were, these articles live on the internet. And so it was really, not only did it, no one wanted to do business with me pretty soon. And I was like a leper. So it was a pretty, bad ending. Not only was I broke, now I was publicly shamed and no one to do business with me. So that was 2005. And the crazy thing is, at that point, the housing market was on fire. It was doing really well, but I was just, meanwhile, I was all distracted with all this craziness. And I ended up by 2008, when everyone else started losing properties, I had lost everything just about. So
holy cow, that is like, literally, you cannot make that up. That is like, you nailed it, straight out of a movie.
Yep. And
unfortunately, what it sounds like is you just were sort of the kind of the face, the scapegoat, basically. Yep. Right? Because ultimately the city wanted that property. That's just heavy NIMBYism right there. And they pounced on that opportunity. Gosh, yeah, it's wild.
I didn't see it coming. And I'll tell you, a lot of regrets, a lot of mistakes I made. And here's another big mistake. The mayor's office, before things started really getting acrimonious in that summer, so about 6 months after the disaster, they summoned, I heard about it in the newspaper, but I was being summoned to City Hall to meet with the mayor's chief of staff. And I was to bring all my tax returns, all the profit and loss on the property, all this kind of stuff. So I went ahead and did it. And when I went down there, they said, hey, why don't you move all your tax credits? We had like $10 million in tax credits, low-income housing tax credits. Why don't you move all your tax credits why don't you move your Section 8 contract? You know, if you find another property in Columbus, we'll support you to try to do this. And I was so single-minded, I'm going to rebuild this property, that I didn't realize that if I said no, which is what I did, then they were going to, okay, well, we're still going to get what we want. It's just going to be, now we're not going to cooperate with you. And so I should have said yes. I should have read between the lines, which I was naive at political things. So I said, no, I'll just fix this one, and I'm fine. And that was, so I if I was a little more, I don't know, a little less, you know, what got me there, what got me from, you know, I have a GED, so this is all self-taught. And listening, and I read a ton of books and stuff like that, but I figured this out on my own. But the single-minded, high focus determination, where you're just like, here's the goal, I'm going to get there. That had served me super well throughout my life, businesses, bike racing, building this kind of mini real estate empire. But it's what drove my downfall. When I was like blinders on, this is what I'm going to do. I'm going to rebuild this property and get everything back. And that, if I had been open to other options and not been so overly focused, it would have probably been better for me. It's easy to think. Luckily it's been a lot of years. For a while, I talk about, I get kind of emotional, but now it's kind of enough time has passed that I'm okay with what happened.
Yeah, that's one that will sting forever, though. I can imagine. You know, because of course, like you said, in hindsight, you know, read between the lines
Yeah.
and all these things, and it just goes, you know, you take on those politicians, you know, it's crazy even at the municipal level. I mean, it is Columbus, but that's crazy, and I'm sure, you know, helps kind of ease some of the people who are going through similar situations, or at least, you know, the ones you're helping kind of ease it, that it's not, you know, theirs is, you know, probably just one single residence. And of course it's all relative, right? To someone that typically that's our largest investment. So it's, so kind of talk about, you know, how that led to the creation of these companies and what
Sure.
you're really doing to help people.
Yeah, so I started the nonprofit actually to help families at risk of foreclosure called American Homeowner Preservation. We started that in 2008. And it was myself and two other people, and we families would come to us and we'd advocate on their behalf one by one with their lender or servicer. That we had thousands of families come to us, but it didn't work that well because if you remember the stories from that time, 08, 09, the servicers were overwhelmed. They would take months to respond. They'd lose lose like paycheck stubs and all this kind of stuff. So it was really inefficient. So we only helped about 10% of the people that came to us, and we said, hey, this really isn't working. So I pivoted and we became a for-profit, and we started buying defaulted mortgages from banks and hedge funds. That was the pivot that worked. Now we were able to bring in investor money, buy these. And once we owned the loan, we could do whatever we wanted. If the homeowner wanted to stay with a modification, great, you get a mod. If you don't want the home anymore, you've already moved on, we'll give you cash to sign a deed in lieu. And now we buy these loans at such big discounts that almost every option made money. And to give you an idea of the discounts, if somebody owed 100 and now the house was only worth 50, super common situation back then, we could probably buy that loan for 20 grand. So, you know, if someone gave us a deed in lieu, we give them $1,000, and then we could put the property on the market, sell it, and you know, we make a good return. If they wanted to do a mod, we would do a mod. We'd cut principal, waive some of their delinquency, reduce their payment and interest. But because we bought it so cheap, we'd still have flexibility. And the market, but in fairness though, this is the market in 2010, 11, 12, 13, 14. Just because you got a deed in lieu, for example, back then, the properties still move pretty slowly. Today things fly off the shelves, but at that point, you know, we'd sell, but we'd have to discount the price to make it attractive. And then the mods, you know, now the people just start paying us, and it was a good. It was really exciting because we were tiny, but at that point in time, there were more sellers than buyers. So within 6 months, we were buying from Banco Popular, Citibank, Aurora Bank, FDIC, because there weren't enough buyers, and we were willing. Not only were we willing, we wanted to buy mortgages secured by homes in low-income neighborhoods. This is where the greatest social impact can be made, and also where the bigger hedge funds that buy these loans, they don't want the stuff that's with values under 75 grand. But they think, hey, you can make 5 or 10 grand. It's a ton of work. Same work that you're going to do if you do resolve a loan backed by a 500 grand home. It's just not worth it to us. So we had the pricing was very favorable on those, and that's where we focused our efforts. And last decade we bought more than 10,000 loans. The opportunity has shrunk, though. As the market heated up, more people were willing to buy whatever, and now it turned, so they became more buyers than sellers, and the inventory shrunk, and so we're no longer a buyer at any scale, more of a seller. But the market will come back, in the next downturn, and since then, we've put our efforts into preparing for the next downturn. One of the things is we built a national mortgage servicer, AHP Servicing, a national mortgage originator, AHP Mortgage Direct, a trustee, a foreclosure law firm. All these things will thrive in a downturn. And so we're building for that next downturn. preREO is a marketplace where institutions can sell defaulted mortgages on a one-off basis to real estate investors. And so it's kind of like auction.com, but instead of buying the REO, you're buying it before it goes REO. You're buying it as a defaulted mortgage. And that's been well received by institutions, well received by the buyers. It's something where they can buy it at a big discount, and then they get to work it through the foreclosure process. And most of these, once they're in foreclosure, they become REO. There are some that turn into mods, which can also be financially rewarding.
Wow. That's fascinating. What very interesting business models to kind of build. Did COVID, were like any increase in foreclosures or potential foreclosures come to you because of COVID, or no, because of all the moratoriums and everything?
Yeah, no, COVID had a lot of odd consequences. One, at the very beginning of COVID, it was very, very challenging. Just any business owner in the country, it was challenging. And I was concerned that this was, we're overdue for a downturn. I was thinking at that point, hey, COVID's going to trigger the downturn. Complete opposite happened, but no one really knew that at the time. So we went on a buying spree. We bought about $100 million worth of defaulted mortgages in the second half of 2020, and that has what we bought then has done really well, as the rest of our portfolio, just because the market has since been on fire. But at the time, people, if you remember back in the first weeks of COVID, stock market collapsing, for a lot of lenders had their credit lines pulled, non-QM lenders, fix and flip lenders, and people were uncertain about the market. Hey, do we exit now in a hurry and do better than if we wait 6 months? But I don't think, me for sure, did not believe that 6 months later the real estate market would start exploding, and it's just been an incredible ride. I'd on the market, I'd be this is going to end at some point. Interest rates have already ticking up. The stock market has gotten rocky again. The real estate market is still super strong, but I don't think the legs are there. I think it will, whether it's late in 2022, sometime in 2023, at some point, this starts going the other direction, and opportunities will again be widely available, because right now it's tough to find stuff, whether buying real estate or buying defaulted mortgages. There are opportunities, but they're not. It's not like that flood like we had 10 years ago.
Interesting. Yeah, I'm right there with you in terms of my outlook, especially, the stock market is typically the leading indicator.
Mm-hmm.
I think we're officially in a bear market as of today. Actually, yesterday we had an uptick, but I believe as of today we've officially hit 20% drop in the S&P since January, which they're saying is the peak.
Mm-hmm.
So we may officially be in that bear market now. Certainly, this is everything like COVID, right? I think from like one whole quarter, we had just an absolute dump, and then it just was a hockey stick since. We are due for it. Any idea what, I think so many people, have such a heavy PTSD from 2008 that immediately people are like, no, I'm not doing real estate. Investors are looking for places to put it. I'm obviously biased. I still think real estate is a thing. I don't think that real estate's going to get crushed like it did in 08. I think we put enough things in place. I think lenders wised up at least enough. What are your kind of thoughts in terms of how it'll affect real estate?
Yeah, I'm a little more pessimistic. I'll look at history. I mean, history is always a good guide for everything. If you look back through centuries, really, our country's on currently the largest economic expansion in our country's history. It has been, COVID should have been the time where it turns. Instead, it went up another, call it 30% in many markets after rising for 5-6 years before that. This had, or even a little bit longer. But what's happening right now is, you look back at 06 and 07. 06 and 07, the market hit a peak looking at the rate of appreciation. So the rate of appreciation in 04, 05, 06 kept going up and up and up. And now some point in late 2006, it hit a peak of the rate of appreciation. So after that, home values were still going up, but just at a slower pace. So now it's just like right now. So home values are probably even better than they were in January, but that rate of appreciation has slowed, and it continued to slow until sometime in 2008. Hey, home values are 07, 08. Home values are no longer going up. Now they're going down, and I think we're on that same track, or same trajectory. I think in 2023, it's highly likely that that rate of appreciation will have slowed to the point where now it's going the other direction. Now the extent of that, to your point, the extent of the decline is unknown. And I do agree that lenders have largely wised up. However, there are still a lot of non-QM loans. There's a lot of fix and flip loans. And the reality is FHA has become like the new subprime. I mean, you can get a loan with very flexible terms through the FHA. And that's great in terms of providing a opportunity for homeownership for all. But it's not so good when when people who maybe are financially fragile, maybe don't have a big safety net, get caught in a downturn, which has the potential of happening. So the FHA may be the one getting pummeled more this time than last time, when it was more all these subprime lenders who took hits, or all the subprime loans that were originated. So it's hard to say, but history will tell us we're in for a significant, in my mind, a significant drop. The question for me is when the market. I mean, my brother and my nephew is just sold his house in California, sold in a couple of days, closed really fast, and now he's buying in New Mexico, and he's like putting, he makes a full price offer. Oh, everything is multiple offers. It's on the market for a few days, and I guess that's very common around the country. But it's just remarkable that even with the increase in interest rates, significant increase in interest rates over the last few months, and we're still seeing this feverish activity. It hasn't done much to slow down the real estate market. But you're right. Is the stock market a leading indicator, and is the real estate in 6 months going to start getting sluggish, and now people going the other direction?
Yeah, it'll be interesting to keep an eye on for sure, kind of where it happens. One thing I'm certainly keeping an eye on, I'm more commercial focused, is, the asset prices. Obviously, as you've seen in some of these markets, is insane, right? And it's certainly, one thing people need to understand in commercial real estate, it's a little bit different, right? Interest rates aren't necessarily interest rate and cap rate aren't, mutually exclusive. You have other factors, that kind of thing. But, certainly deals are getting done and across the finish line with some interesting debt stacks that I think could potentially be an issue. But yeah, I mean, it's anybody's guess. There's so much capital in real estate now that it's like, is that going to prop it up? Are we going to be okay? Is it only going to be, 12% in some markets, and other markets are going to be fine? Yeah, a lot, but we're there. We're way overdue. I mean, gosh, what is that? 14 years ago now. So
yeah, exactly.
I think it's every like 10 to 12 years. So
we are overdue.
This influx of, obviously, what is this, like 20 or even 40% of all the money in circulation has been produced in the last like 2 years. That's propped us up. That can't last. So we could be headed for a perfect storm of just absolute disaster.
Yeah, but it's not bad. I think
No.
it's healthy. Economy, it can't just go up, up, up. And the real estate market by extension, there's a healthy expansion, contraction, expansion, contraction. That's what needs to happen. The fact that we're overdue makes the contraction potentially worse. I mean, think about this. The buyers who are buying today may be at greatest risk. You know, my nephew buys this home in New Mexico, and I've told him, hey, I don't think the market's going to be that strong for that much longer. Maybe you could rent for a year and then buy. But no, I want to buy. And so but
well, coming from California, it's probably pennies compared to.
Yeah, exactly. Everything in New Mexico looks like a bargain. Yeah, and anything everywhere almost looks like a bargain. I agree with that. But yeah, so he takes some money that puts down a down payment like that. But the buyers closing today, the market just went back to the prices the day COVID started. There's probably millions of families, especially all the ones that have bought in this period of feverish buying, that could easily be underwater. And that will, bad things happen when people have no equity. And then, that now it becomes hard to be motivated to continue paying a payment when you realize that, hey, the home across the street from you is for sale, that's identical to your home, and it's for sale for $100,000 less than what you owe on your mortgage. That kind of situation is creates a bad environment, and an environment that then can propel things to get even worse. Let's see what the next year, the next 2 years, the next 3 years could be very interesting in this country. Something has to happen. I mean, like you said, I wasn't even aware of that statistic about all the new money in circulation, but that's led to inflation, to the increase in wages in a lot of sectors, and a lot of artificial factors. Let's say these hyper low interest rates, all these artificial factors. So it's kind of unknown. That's not just a regular market ebb and flow. We throw in all these artificial ingredients and now see what happens. I don't know if anyone even knows.
No, I think we're headed into a new, just like 08, right? Nobody thought the housing market could collapse, so I think we're headed to something of that extent, and like you said, it needs to happen, of course. The important thing, for those listening is just set yourself up, right? Don't be over leveraged, maybe less speculative on your investment. Like there's things you can do to prepare. And I think now is the time to start preparing, right? I think we got lucky with COVID where it was just kind of a quarter and then we hit a hockey stick, but I think that luck is running out. I think that this, kind of dump in the stock market is a really good indicator that something is actually coming this time. But we are kind of coming up on time. I do want to touch on crowdfunding though.
Absolutely.
So kind of talk about crowdfunding and real estate, preREO and all that.
Sure. So here's when we started, as we grew, as American Homeowner Preservation grew, needed more money, new investors to buy defaulted mortgages. In 2013, we heard about crowdfunding. So we set up our site and we started offering our investment. And it was at that point, you could only crowdfund from accredited investors, basically more or less the richest 5% of the country. And so that's what we would do. And we attracted some investors and used that money to buy defaulted loans and had some success. But in 2016, they expanded the law to allow crowdfunding from accredited and non-accredited investors. So that was really a trigger to really grow our fundraising efforts. We did our first Regulation A+ fund in 2016. We raised just over 40 million. We then raised money starting in 2018 to build the National Servicer, AHP servicing, as well as buy defaulted mortgages. That fund has raised about 60 million. So those are, so we've had some great success with crowdfunding. And now with preREO, we started preREO is both building the preREO platform, but also when somebody buys a defaulted mortgage on preREO, we offer 75% financing. So they put down 25%, we'll finance 75%. And so the money that we raise on preREO, the bulk of that money goes to helping finance these preREO investors, which is great. I'm seeing it the same as you. We need to plan for these uncertain times, and so we pay up to 7%. It's distributed monthly, And that money is invested in these pre-REO financing. So if somebody buys a defaulted mortgage on pre-REO and it has a property values roughly $200,000, they could probably buy that mortgage for about 150. And the mortgage, they probably, in most cases, they will owe more than the property's worth. So they buy the, let's say, $250,000 mortgage secured by a property worth 200. They buy it for 150, and then they'll put down 25%. We'll finance 75%. So in the end, we're financing, in that example, $112,000 on a property that's worth $200,000 to an investor who just put down 25%. So we've delevered significantly and de-risked, in my mind, and that will help us get through this transition. I'm hoping everybody who buys a mortgage does great. We've had a lot of investors make tens of thousands. A few have made hundreds of thousands on single note investments. Wow. One investor on one deal made more than $1 million. So it was on a multi-million-dollar home, but fair. There's money to be made, especially when you're only putting down 25%. So it's worked out well for everybody. But as the market starts turning, it will be, I feel that this is a good investment to kind of, for this transition period, to get to the other side, where you're still getting a good return, but you're also, and you're still in the real estate market, but you're not buying a property for 200, which has a reasonable likelihood of going down. Hey, I mean, at the beginning of COVID, I said, hey, things are probably going to go down. They went up. So I really don't know. But with that uncertainty, the ability to crowdfund as little, you can start with as little as $100 and make and generate a good return from during this uncertain market. And the focus is principal preservation. I mean, it's great to get a good return, but the worst thing is to avoid losing money, which if you buy a piece of real estate today at $200,000 as an example, and it drops 10% to 180, hey, forget about like I am trying to earn 5%, 10%, whatever you're earning. Hey, you just lost 20,000 bucks. So that is something that is going to happen at some point. This market has to contract. The uncertainty is timing, but that's, I think, the most important thing to avoid. And number two is to find places where, hey, if the market does go down by 10, 20, 25%. I mean, in the Depression and the Great Recession, things went down about 30%. So what can you do to survive and still do well through those times?
Absolutely. Yeah, that's a fascinating model, and really awesome that they opened that up to non-accredited investors as well. Kind of give everyone a chance to play in that game, because like you said, the returns are there. Mm-hmm. And then in terms of interest rates, are your interest rates the same? Do you just do like, +1 over the what?
Yeah, here's what we do. So these are investors who are buying. Historically, there's not been very many opportunities to finance a note. Tons of opportunities to finance, or outlets to finance a piece of real estate, but not so much money available to finance a mortgage secured by a piece of real estate. So we finance investors at 12%, and we pay our. So if someone's buying a note on pre-REO and they need financing, we do it at 12%, and then we pay our investors 7%. Our business model, we make the 5% in the middle. That's our spread, and that is, and that allows, if there is a loss. We've only had one forfeiture so far in our since we've been doing this over a year and a half. So we're still new, but we have a ton of experience in this, so I'm pretty comfortable with the model and the structure. So I think this is built for this market that we're entering into right now.
Awesome. I love that. That's what a great business model. Cool. Well, that brings us to the final 5. First question, best advice you've gotten from a mentor?
Make your service or product as simple to understand as possible.
I love that. What is it about your career that makes you feel like you're fulfilling your why?
So right now, what I do is to try to level the playing field for all. Our focus is home ownership. We are trying to help create and retain homeowners, particularly those who are of lower income. So very low and moderate income homeowners, which are disproportionately minorities. And the reality is this country has been unfair. It's been an unfair playing field for decades, centuries probably, for many minorities. I mean, just as I won't go too far off on this, but from the 30s to 1968, 98% of federally backed mortgages went to white families, which sparked an explosion of wealth for white families. Only 2% went to minorities. That's outrageous. In that period, it was legal for banks to discriminate on race, and that is an outrage. It's shocking. I was born in 65, so when I was born, minorities, a white family could go to a bank, African-American family could go to a bank, identical credit, identical income. The bank could legally say, I'm not going to make the loan to the African-American family simply because they're African-American. That's an outrage. That has not stopped. There's still, it's no longer legal, but there's still a lot of discrimination in our society, and especially at financial institutions. That has to stop. That is something that we are focused on, and we will try to do our part to improve.
Awesome. I love that. I did not realize, I mean, I was aware that they could discriminate. I didn't realize it was that severe. That's crazy. Favorite non-real estate or investment related book?
I'll make a selfish pitch. So I wrote a book called Burn Zones, which is it doesn't show up that well, but Burn Zones tells my story, my rise and fall and rebirth. And the reason it started out as an explanation letter, explain, hey, all this chaos, why do you lose all this money, all these judgments against me, these bad news stories. And so I wrote the book, and I wanted just like, okay, if somebody has a problem, read the book. But what's been good about reading the book or putting out the book is that people like to see people that have come back from adversity. So a lot of people you don't realize have overcome adversity in their life in one shape or form, whether it's financial, relationship, health, all kinds of things, and they've done it. And so that story has resonated with people and attracted people to the businesses in whatever capacity. So that's my favorite book. It's very personal. I'll tell you, when I wrote it, I cried and I laughed. Different sections as I went back and kind of went through my history, but people tell me they cry. There's a couple parts where most people cry, and I know I was crying when I wrote it. So that's it was a very therapeutic experience.
Awesome. I love that. Bittersweet, of course, but again, so awesome you were able to rise from the ashes. If you could have any superpower, what would it be?
If I could somehow, and I'm not sure how to translate into a superpower, but I could somehow make this society more just. And it's not just our society, the US, it's the whole world. How to avoid having people, whether they're bullied, but like literally bullied as kids, but really people, Wall Street sometimes bullies consumers, especially those of more modest means, and I'll throw payday loans or something like that. Payday loans, subprime auto loans, these things pockmark low-income communities, and they're just a scourge, and they suck the wealth, whatever income, whatever that is in these communities, they suck it, and it ends up on Wall Street. And that is a problem for our society. Our society needs to become more inclusive, fair, and the wealth gap and the income gap in this country are extraordinary. It's good for people to do well, but everybody needs to do well. It can't just be the people at the top, and that needs to change. It isn't changing very much right now. In fact, since COVID, or even since 2011, all the crises, basically those best off the most well off in our society tend to do disproportionately better than those of more modest means. That has to change. If I had a superpower, I'd love to be able to change that.
Gosh, I love that so much. It's so true. Awesome. Last question. What's the best way for people to get a hold of you and learn more?
Sure. preREO.com. And they can reach out to us. Our phone number is 800-555-1055. But yeah, go to preREO.com and you'll see other ways to contact us.
Cool. Well, you will link down in the show notes, Jorge. I cannot thank you enough. Thank you so much for your time.
Thanks a lot, Jonathan.
Absolutely. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.